We've talked a lot about, maybe we've talked enough about the flattening yield curve, Greg, for right now. But what does it say for me and my investments and my portfolio? What should I lean away from? What should I lean toward?
I think that's a great question. When you look at it, I think what it's saying is that risk is rising in the equity markets. We are getting an inconsistent message right now from the bond market to the equity markets. I think you'd be hard-pressed to come up with a thesis as to why these higher bond prices should lead to higher equity prices. In the past, we'd talk about having no alternatives on the bond side, the TINA statement. And now bonds are very much a reasonable option with higher yields if you assume that inflation is going to be calmed down. But I think the clear message is that risk is rising for your equity portfolio.
And so if risk is rising for my equity portfolio, what do I want to lighten up on? I'm sure you're not a market timer. Almost nobody who makes money in this business is. But where would you be putting fresh money to protect against what you see in the equity, the threats you see in the equity market?
Sure. I think you want to pivot off what the current situation is offering you as an opportunity. And when I look at it, the things that are rebounding now are consumer-centric. Some of the early worries in the year that were the consumer stocks were going to get hurt as rates rose. I think you're seeing a lot of consumer stocks today kind of rallying back. And I think over the next 3 or 4 months, there's a lot of headwinds that the consumer faces, whether it's on the lower end and it's student debt, starting to be repaid back again, whether it's higher mortgage rates and what's that going to do to borrowing and things like home equity. So I think when we look at making new money investments, we're looking for non-economically sensitive names and non-economically sensitive sectors.
Well, that might help explain why a name like Chubb, which we don't often hear from stock pickers, why that one pops up, BlackRock, United Health Group. Is that the kind of common thread there?
Yeah, I think the common thread, if you look at it, is obviously within financials, banks have done tremendously well on the prospect of higher rates. At some point, that will lose steam. And when banks lose steam and people are worried about the economy, insurance stocks tend to do very well. If you look at a name like UNH, while labor is an issue, it's not a consumer-centric name. Healthcare is not as economically sensitive as other areas of the economy. And last but not least, you never want to not be taking offensive opportunities. BlackRock is a phenomenal company, a stock that people like for the long term. It's already down a lot with the market being down, so on pullbacks, it's a great long-term investment.